Hello there. My name is Doug Lennick. I'm with Adam Recker, and you are with Smart Money Moves. We're excited to be with you today. Adam, as you know, is a CFA and a CFP. We share that CFP designation, and I am also a BFA, which you may know less about. That's called a behavioral financial advisor. So today, Adam, we're talking about some stuff everybody needs to know in retirement, what every retiree needs to know, probably everybody needs to know, but we'll focus and call them, we want to talk retirees. So let's go to that. Let's see what do you got for us today?
So let's flip to the next slide, and I think a good part of this call being the end of the year, it could be serve as a nice recap of kind of what we're seeing in the market in 2025, and then using that information and just what we know about the markets, look ahead to 2026, and again address those things that are probably best keeping top of mind. And so, from maybe a recap perspective, we've continued to see a strong run in the market as in the market being the S&P 500 U.S. stock market in particular. However, that's not the only market that's done well this year, which we'll touch on here. But obviously, valuations have continued to run as the market has gone up in value. That's been a point of concern for many, which some of that's justified from a concern perspective, but also the higher valuations themselves are also possibly
Now,
justified. And so
I know one thing that our viewers like to know is how do you personally feel? I mean, what's your sense of things? I mean, do you see overvalued, properly valued, what it makes sense to you, or how do you think about it?
Yeah, I would say it's one of the things that I believe, and I think our team believes, the greater organization believes, is that things feel maybe a little bit more stretched, and that is justification for maybe a little bit heightened caution. But I think let's go to the next slide to kind of continue the thought process. Um, Things to keep in mind are, while valuations are good long-term predictors of future returns, and long-term being not tomorrow, a year from now, but call it 5 years plus before you start to see any sort of statistical significance, maybe even 10 years before there's a real relationship that forms. You want to keep in mind heightened valuations lead to risk, but again, you can't use it to consistently time the market in any sense,
Yeah.
and make decisions. And
Well,
so,
and one of the things I think all of our clients and those who are not but are listening and watching appreciate knowing you're not into market timing. What I like about you, and you and I've talked about this, is what you do is you prepare pretty much for all the possibilities and you understand the probabilities both. So it's kind of a fun thing. So you pay attention to that, and I think it's useful for everybody to understand that's happening behind the scenes right here.
like the valuation piece, again, it's higher, but I don't think it's an argument to say, hey, you don't own the U.S. stock market or these kinds of companies, or you go to cash, especially. That's not the recommendation or what we believe to be a prudent course of action, because one mitigating factor here is that, again, some of the common talking points, valuations are higher. But at the same time, if you're looking at sort of the right hand side of this chart, in a way, opposed to, like, say, the tech bubble, some of it's more justified because earnings have been really, really good. And it's not just valuations that drive the market, but long term, it's that earnings growth is really a powerful driver behind stock markets. And as long as earnings can continue growing, and the expectation for 2026 from many is that's exactly the case that's expected, double digit earning growth, that can continue to propel the market further. But again, valuation is important. Earnings can grow and valuations can fall. Like, that's possible too if sentiment shifts. But as of now, the fact that there are very, very good companies out there, very profitable companies, earnings are expected to be positive still. There can still be room to run. And so you don't want to go to cash.
No,
That being said, there are other opportunities out there. You don't need to buy just the most expensive companies out there or the US or things that maybe have growing risk associated with them. And you can look at other asset classes. Like, again, looking at 2025, international markets have been really, really good and have outperformed the US, generally speaking. And if you look at the foreign segment versus the US, benefits there, valuations are more reasonable. Dollar strength turning into dollar weakness has been a key driver of those returns. And even looking at things like AI, you get quite a bit of exposure in emerging markets, China in particular, for those that are comfortable owning that. It's not just a US based phenomenon. And again, like in the US, earnings are expected to be positive or even increasing and accelerating in foreign markets in the coming year. And so a lot of the drivers that have propelled markets higher across the globe, not just confined to the US, are still generally expected to continue in 2026. And evaluations or growing concentration is a concern, which concentration and growing concentration, while a risk, especially when you look at like an individual stock in a portfolio, is really a sign of a bull market. That tends to happen when markets are going up. And so our advice is looking ahead, you don't need to own just the US. And high valuations and concentration in and of themselves are not a reason to get out of the market. If it's causing concern, it's more of a sign that maybe it should, again, consider greater diversification, taking appropriate levels of risk for your particular plan.
Well, and overall, on the behavioral side of things, one of the things that we certainly recommend is that people position themselves such that they have money so that whenever they have money in places so that whenever they need some money, there's a smart place to get it. Sometimes the smart place is to take some money that's profitable off the market. But sometimes the smart place is to leave the money in the market and to use some cash or some other money that we might have. And that's why we call this program the Smart Money Moves. What we're saying is the place to take money from, the smart place to take money from moves. Sometimes that title can fool people. Oh, that's what that means. Yes. So like when your home burns down, the smart money is in your property insurance, not in your portfolio. And not that we want anybody's home to burn down, but the smart money moves. And what you're talking about is we don't want to be out of the markets because there's a real possibility and markets are going to continue to go up. If the day you need money, the markets aren't where you want them to be, you want to have some cash. I'll just leave it at that, let you get back to this. I love this because in previous episodes too, we kind of think about it in the really long term, and if we could put 2025 and 2026 in the period of the years 2000 to 2050, which we can't, but we'd be right in the middle of that. And where would we be? My guess is by 2050, it's going to be higher.
Yep.
you know, but it'll zig and zag its way up there. So back to you, Adam.
I think those are all great points that lead into the next chart that we can show for a second. Again, having the right place to pull money from, and again, it's not about, as you already said, taking no risk or taking all risk. It's you don't want to take too much risk and be in a position where you can't ride out those inevitable periods of adversity in the market and be forced to sell things at low prices because you have no other choice. Like you have to have safe assets to pull from when markets are down. And this chart here on the page really speaks to that, what we call a sequence of return risk, where especially speaking to retirees or those that are in the initial years of their retirement, if markets kind of just go the normal, 7%, 6%, whatever it is for your level of risk, but generally positive growth over time, and you don't have a major pullback when retirement starts, that's sort of that middle line, you meet your goals, you get to your end destination, and you're fine. Same thing if you start your retirement, and in those early years, returns are very, very strong. you can afford to take money out because the market's growing. There's not a major risk to the plan, all relatively speaking. The risk that we need to prevent against is when there's a bad start or a pullback right when retirement starts. Because having, if you're too risky and you're taking on too much risk and those assets you own are overly exposed to pullbacks in the market, and in the midst of a pullback, you have no choice but to pull money out of those assets that have fallen in value to meet your living needs. What we call, a bad timing scenario, that initial pullback can have devastating consequences years down the road for your overall plan. And so the better course of action, even when it feels good to be aggressive because the market's going up, you don't want to miss out. You have to acknowledge that there is a risk there could be a major pullback. And so you plan for that, even if it doesn't happen, because for those where it does happen, you'll be grateful to have sort of that emergency fund in a sense, which could be not just, a year, it might be 3, 4, 5, 10 years of spending to really feel safe, where you pull from those safe assets that have held up in value, like you say, the smart place to pull so that there is time for the market to recover. And then when it recovers, you can then start to pull from those more aggressive assets once again. But we have
as I love this, and as I look at this, Adam, one little thing that is coming to my mind, and I know this may be very well be an oversimplification, but if you just think about that zero, let's say today is time zero, and then we have these years of spending. Let's say along the way at year 3, someone in the family ends up needing to go to a nursing home. We want to have been prepared for that too.
Mhm.
And at year 10, someone in the family passes away. We want to be prepared for that too. So comprehensive planning and advice prepares you for the certainty of uncertainty, not just market uncertainties, but life uncertainties, health, length of life, stuff like that. And one of the things you'll find with your Mather Group advisors is they are comprehensive in how they can talk with you and plan with you. We will help you with this part of it very well. And Adam and his team are amongst the best in the industry. And I'm really proud to be associated with them. So I just did that oversimplify it, but kind of help tell the story of what getting ready for uncertainty means.
no, and I don't. I think much of our industry could use a little bit more simplification to be a little bit more accessible. And so that's exactly the point. Unexpected things are going to happen, both in the markets, both from a personal standpoint. We need to find ways to plan for those because risk isn't the volatility in the market. It's the things that nobody sees coming, whether that's you or the professionals. Because if you could see it coming, it wouldn't be a risk. Not exactly profound, but sometimes is kind of missed amidst all the noise.
No, exactly right. And that what is why planning makes so much sense and why it produces so much value for those who are prepared. So that whenever you need to put your hands on some money, there's a smart place to get it. And we want to be ready for that, and we're proud to help you be ready.
Yeah.
I love this particular chart right here. It's very helpful.
So I think again for the preparation, kind of moving on to the next few slides. One of the things we had been talking about, and always feeds into the overall aspect of planning, both from a financial planning perspective, but also from an investing perspective. And a lot of questions top of mind on this topic, given just changes we see upcoming at the Fed, or even things going on in our economy. And so questions that have come in is like, is a higher level of inflation the new normal to expect? Because that's going to have an effect on spending for clients. Because again, we go to the grocery store, you go out, you buy things, you can see prices have risen. And even with inflation, for like CPI, around 2.7% most recent reading, it feels like things are slowing or cooling from an inflation standpoint. but it doesn't change the fact that things are still incrementally more expensive over time. And that's really where I think consumers disagree. They say, oh, it feels like inflation's down, but things are still expensive because those things are not going down in value unless we have deflation. And
Right.
so,
And I think sometimes that in and of itself on the emotional side is confusing us intellectually because we think when inflation is low, that means prices are going down. No, it doesn't. It means they're going up less quickly.
right,
They're, so people are expecting prices to get lower. That's not going to happen probably anytime soon. And we don't really want deflation.
no,
No. So there's that, as they say. So we want to be careful what we wish for. What we want, though, is we want to be able to afford our lives. And that's why we step into dealing with topics like this. So this is really important for people to grasp, but don't expect the prices of things to go down really soon.
and that's maybe starting with that, and that's very important. Like, why won't they go down? It's because deflation is very devastating. If prices fall in value, usually because there's a lack of demand, consumers will sit and they'll wait because why would you buy something now when you can buy it at a lower price in the future? Consumer spending slows, if not stops. Our economy is built upon that, and things just cease to function. Tax receipts are fall, and so we can't service the debt. Like, above all, things, deflation is very, very bad. And so what the Fed wants, since the mandate is really employment and price stability, meaning not no inflation, but an acceptable level of inflation, they've historically been targeting about a 2% inflation rate. And so it can run a little bit hotter, it can run colder over time, but long term, really that arbitrary 2% is a function of just a level where mathematically things work pretty well, where there's still room to raise rates if inflation gets too hot, and some room where they can cut if the economy really starts to stagnate. Again, where did this all come from? If we look back further, and this will pop up on a future chart here in a second, we had periods of very high inflation, 70s, 80s, 90s. After that, the Fed decided, we need to, take things in our hands a little bit more, try to manage the economy a bit better, where if inflation runs hot, we raise rates to choke off growth and get things under control. If things stagnate, we cut rates and we try to stimulate. And all things considered, looking from about the 1990s to the 2020s before the most recent inflation spike, they did a pretty good job of it, where inflation ended up being right around 2%. And on this page, I should address, we have things like CPI. That's one measure of inflation that's reported in the overall economy in the news, but it doesn't encompass everything. It really focuses on more urban consumers and things like that. The Fed's preferred measure is PCE. And so that is a bit broader based, just for a little bit more context, where it's not just urban, but also rural consumers, and also allows for substituting different goods and services when prices are higher. And so really meant to be a more applicable measure of inflation for the average person. And so when we look at 2000 to even more recent periods encompassing the inflation spike, you can see we really weren't at 2%. And so especially with the spike, we're actually around, in the case of PC, around 2.2%, CPI around 2.6%. And so a little bit higher than target. Okay. So let's maybe go to the next chart to kind of have another view. Because again, it zooms in a little bit closer, more recent period that's more applicable to most people, the last 10 years or so. Again, is inflation or a higher rate the new normal? Given they've done a pretty good job at 2%, but we can see we're coming out of a period where we had been very stimulative, deficits been growing, and as a result of that, inflation has risen, sort of a new regime, if you will, where we're actually been closer to, approaching 3% than 2%. And so one of the questions that comes up again is, well, is the Fed going to make 3% the new 2%? My guess is they will never say that, because if you say it's 3% and that's acceptable, expectations will reset at that level. And so whether or not they get down to 2%, I believe they'll continue to say 2% is the target, because that will keep expectations more anchored with lower inflation. However, for our planning purposes, it is probably prudent to assume a bit higher inflation. And so we've never really been assuming 2%. Really, it's more around that 2.5% is probably more realistic. But even accounting for the fact that inflation could run hotter at maybe 3%, is better to assume that perspective. And then if inflation ends up being a bit lower, we'll have more money to spend on other things. But we need to plan and invest for at least probably a bit higher inflation environment than what we've seen in previous years. Another
Well,
quick,
it is interesting, though. One of the things that you touched on, Adam, that I think is something worth paying attention to is the psychology of gradually accepting different things as the new normal. And so it actually, for consumers, when you start hearing 3% and it's not 3%, sounds pretty good after a little while, when in fact, what you're saying is that may sound like it's pretty good, but it's actually not that good, but that psychologically can happen to us, and that can influence behavior. And so they don't want to reset that expectation. That's why that 2% number psychologically remains very important, I think, overall to the economy.
other reasons, again, nothing's guaranteed. Things can happen that are expected, but why? Why also maybe expect higher inflation? It just comes down to things the president has said and others have said, where there's both monetary policy where you control the interest rates, where you actually set the interest rates, but more and more it seems like they're thinking about that through more of a fiscal lens, where there's been comments, well, we need to cut rates because we need to make our debt more inexpensive, like servicing the debt. And so how's that work? It's, well, one, if you can force interest rates lower on fixed income, you can issue debt at lower levels. But at the same time, if the economy runs a bit hotter and inflation picks up, all of that existing debt out there from a government perspective is effectively worth less money and inflated away over time. And so there is some thought that, given we have some issues where we need to, maybe get the deficit down a little bit, you can actually inflate your way out. Now, you don't want hyperinflation, like you see in like Germany back in the day and things like that. It has to be more of a controlled rate, but there does seem to be a willingness to let things run a little bit hotter if certain people get their way.
Well, and so we'll see what happens. Let's keep looking at it.
Yep.
So, new environment, the long view. And
Yep.
that's where we're playing the long game.
Yep.
We're
And so again,
prepared for short-term issues. So keep in mind, the game is to be prepared both for the long and the short. And that's what we're doing. Here's the long view.
yep. And so again, greater context, zooming out further, people 2% as the sort of the new normal, or 2% as the previous regime, is 3% the new normal. Looking out and zooming out further, you can see a wide range of things have happened. And so we had, falling bond market yields where they peaked back in the 80s and fell to a lower rate environment where I believe the 10-year hit sub 1% at the lows, which we've now risen from. Inflation over the years, we had very high rates of inflation. We've had very low rates of inflation. Things move in cycles. We respond as those cycles take place, where either the Fed is raising rates or lowering rates to try and target a more stable price. But saying that a 2% rate is an ironclad law wouldn't be accurate. And so we need to adapt as the market and new data changes as well, and not take anything as a foregone conclusion.
I like that. I like how you're thinking about it, and I like the concept of preparation that we're sharing with everybody. That's the game. those who are prepared will weather the storms. And Adam said it earlier, when things aren't so good, can I weather that? Because if again we look over the long view, we know that pretty much every point in time is a good point in time to be invested for the long haul. So wherever we are today, point in time today, at some point, the idea is we will be up there. Now, we could go down for a while before we get up there, and that's what we're talking about.
And the
And
next
so
chart captures that perfectly. So
let's the wall of worry. I love this. So talk about that.
yeah, so like you said, it's there's definitely pullbacks in the market. There's bull markets, there's bear markets, but like you said, long view, if you can ride out the short terms, which is a matter of controlling risk, having a smart place to pull money from, that allows you to reap the rewards of the market and human progress that we create over time, whether it's due to steam engine being built, the internet, possibly artificial intelligence. Transformative technologies create bubbles, they create busts, but long term, the progress continues. And so having a smart place to pull the money, ride out those storms, allows you to reap the benefits of taking on risk elsewhere.
Well, and here's the deal. People are going to live really long, but not all people. So we're going to be ready for both truths. Let's keep going. That's
So,
out. We're kind of near the wrap here. So
yep,
some top investor questions, and you've given some answers already.
yeah. And so I think again, some of these came in, before we hopped on the call, so we wanted to address it. Is it a risky time to stay invested? Not to be dismissive. It's always risky. It's just there are some areas where there's maybe elevated risk relative to others. It seems, but managing that risk is part of the job. And if we don't take on some sort of risk, we can't reasonably expect to get any reward. And so it's about finding what's the right amount of risk, and do you have areas of safety to pull from when the risk persists and there's inevitable drawdowns in the market. Um,
Well, and related to this too is buying power of money. What happens is if one is all in cash that doesn't
yep,
go down in value, except it buys less.
yep. Not avoiding risk, you're taking on a different one.
Yeah, it's a different kind of risk. So should I be adjusting my plan as we head into 2026? I'll take it first and just say the answer is we should always be adjusting, and we always are adjusting. And that's one of the things, Adam, I know you guys do pretty much on a constant basis. Speak to that.
Yeah, and adjusting doesn't mean market timing or anything like that. Obviously, we're very clear we don't believe that adds value, but it doesn't mean you don't rebalance or you don't lean into maybe areas of the market as part of that rebalancing that maybe are less extended and still have good expected upside, or you don't, again, if you've run up too far, take some, not to use a gambling analogy because it's not gambling, but take chips off the table to shore up some of your finances and the safer aspects of your portfolio. And so that should always be done throughout the year. Even from a broader planning perspective, it's always intelligent to take a step back, reassess, have things in my life changed? Do I need to save more? Can I afford to spend more? Maybe I don't need to take on as much risk these days. Maybe I need to take on more risk. Those are all questions that our financial advisors are well equipped to answer in consultation with their clients.
Well, and the same with the last one, because this really gets very personal regarding your own levels of risk tolerance. And sometimes the concept of risk tolerance is confusing because all of us are willing to take risks that work. The issue sometimes that we fail to pay attention to is loss tolerance. And so in your conversations with your wealth advisor, we should be talking about both, the tolerance for risk, which is elastic, and then that loss tolerance. So be careful for both. And I
Yep.
think we're at the end of our time. So let's do we kind of talked about all these things. Anything you'd want to add before we say goodbye and happy holidays?
Yeah, I think probably insensitive, but we believe optimism pays. You know, markets tend to go up over the long run. Even valuations can continue to grow for a while. Things can get more extended, and they can run much longer than you ever expect. And so, trying to get out of the market at an optimal time is not likely to happen. But at the same time, you have to address that there are potential risks out there, and the stronger the market gets, and the more values go up, the more risk people want to take often. But that strength can also hide the fact that there are growing risks. And so we have to account for the fact that the stronger the market gets, it's just the sooner, eventual downturns will happen. And why will that happen? Because there's both sentiment and fundamentals. Fundamentals, long term earnings, valuations that drive the market in the long run. But those shifts in sentiment can have a significant impact, especially in the short term. And so when everybody is overly bullish, which again, it doesn't seem like that's the case right now, but when everybody gets to be very exuberant, that's usually when things are probably closer to a peak in risk versus when people are very bearish and pessimistic about the world. That can be a great opportunity. And I think, as you've been saying this entire time, Doug, it's a matter of preparation. Nobody has a crystal ball, even with all the data we have on our hands. Like we can't predict what is absolutely going to happen in the future. And so part of the exercise is accounting that things aren't always going to do well. And so we need to prepare for that, especially when things are going well, because preparation after the fact is not preparation. Market's fallen. If we don't get ahead of that, it doesn't do the client any good.
Well, that said it really well, and we really appreciate all of you joining us this month and many of you every month. And please invite friends and family to join us. We're here every month, and we'll be back next year uh, in a month. How's that?
Yeah,
Thank
it's like
you.
I have to look at the calendar. Yeah.
All right. See you next month.
Yeah. Thank
Bye.